Welcome back, ladies and gentlemen. Thank you all for joining me today. Now, again, if you're new to the channel, if you're new here, make sure to, stay tuned, stay subscribed, like the video, all that good stuff. But more importantly, what we do here on the channel is we focus on value investing and more specifically my way and just, the way I'm doing things and the way I'm learning. So today is one of those learning type of days, and it's something that I really wanted to show you guys because not everyone really reads some of the letters and things that other value investors really put out. And I think it's really important that you understand and learn from the mistakes, learn the wins from other people in the same space, especially those who have been successful. So today we're going to be taking a look at Guy Spier's annual letter from 2021. I believe he put this out in March 2022, April 2022. So it's really his annual letter to his shareholders, but really what we're going to be taking a look at is some of his ideas and things, and he actually mentioned two stocks in his letter that I wanted to go over and why they were a win and how it really all came to be and get some insight into that. So with that being said, if you're interested in that kind of thing, stay tuned and make sure to subscribe and like the video. With that being said, let's dive right into it. Now, of course, if you want to find this letter, just go on the Aquamarine Fund. That is the name of his fund. Go to Aquamarine Fund, type in annual letter. This is the first year that he's actually putting out these letters, and I believe he's planning on doing it from now going forward. His good friend Monish, I don't believe those are public, but it would be interesting to see if you know of any others in the same space that are public to just go see them. But that's not what's important now. What's important is the actual letter. So he goes in, opens up about how well he did versus S&P 500, and we're not shareholders, or you might be in his fund, but we're not shareholders in his fund here. So I'm just going to go through some of the big things and why it's important. Now he opens up with talking about his returns versus the S&P 500, which the last couple of years I believe he has lagged. But that's okay. So we're going to take a look at some of the stuff that he was really talking about and why it's important and what he's trying to do. So it says, as I explained in Aquamarine's investing principles, my goal is to compound wealth at a high rate while minimizing the risk of permanent losses of capital. In order to keep my sights on the horizon, I frame the investing challenge as follows. I seek to double the Aquamarine's fund's price per share as many times as possible over the course of my investing lifetime. To achieve this goal, I aim to compound my investors' wealth at the highest possible rate, but in a manner that minimizes the probability of a loss. Part of the challenge in a year like 2021 is that the S&P 500 became increasingly skewed and unrepresentative. Its returns came primarily from an ever-narrowing group of stocks, mainly the FANGs, and a few other market darlings, including cloud computing companies, software as service companies, and other new economy businesses. In fact, 34% of the S&P 500's return came from these five stocks: Microsoft, Apple, Nvidia, Alphabet, and Tesla. So it's really interesting to see him talk about, and the thing is too, is he's not making an excuse. That's not what he's doing at all. He's not making an excuse for why he underperformed. He's just merely stating that if you're comparing, so the Aquamarine Fund returned 23.8% and the S&P 500 returned 28.7% in 2021. So when you take those numbers and you're like, what in the world? There are times in, years almost where value investing doesn't necessarily outperform, but over the long run, as a patient investor, you end up outperforming. And so he goes on to talk about, what drove 2021's market, really 2020 and 2021's market, but 2021 is what he's talking about. He goes on to talk about how Tesla, Zoom, Peloton, Spotify, Netflix, Roku, Cloudflare, and some others had some crazy multiples, and how people were completely shilling some of these companies and unwilling to sort of let it go. One of the other things that he had talked about was how analysts are kind of getting away from profitable businesses, and they're just, coming up with different reasons for why unprofitable businesses or just no growth, no profitable growth businesses are doing well. So he's talking about, to justify their enthusiasm, these analysts like to focus on their own favorite measures of corporate well-being. Talk about unit economics, customer acquisition costs, and lifetime value of the customer. These metrics allow them to claim that a company is indeed profitable on a unit basis, and they then predict what a steady state would look like. So, and this is, when you look at someone like Guy Spier, he's looking at a probability. So he's trying to figure out, what is my probability of loss? What is my probability of actually making money? And Seth Klarman also had mentioned this too, and I think I talked to you about it in my video with Seth Klarman. His interview that he did with HBS is really your goal should be to minimize risk and then focus on returns. A lot of people focus on returns and don't think about the risks at all in terms of the probability of, you know, your play going bust. So the other thing that he mentioned, he said, as I see it, the key for us here at Aquamarine is remain firmly focused on economic reality, on what's tangible, reasonable, and rational. Inevitability, there are periods when financial metrics don't seem to matter and when discipline is penalized, at least for a while. It's not pleasant when your investment's approach is out of favor. Still, it all comes back to this timeless insight from Benjamin Graham that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Valuation matters. It always matters. And, you know, he goes on to say, you know, I'm not being defensive of our underperformance. That's not an excuse. But just going on to say that if you're going to invest into businesses and you're investing into profitable businesses, there's going to be times where Mr. Market is, you know, manic and just going to the moon and taking everything with it. There's going to be other times where he's going to be super depressive, and that's really your buying times. So what we're focusing on really here is just some of the things that he has done and some of the plays that he's made, and he actually talked about BYD and IEX, and I'm just going to read that to you and kind of go over and give you some of my thoughts. So the first stock is BYD, a Chinese electric car and battery company which we've owned since 2011. What first piqued my curiosity was in fact that it had passed through filters of 3 of the smartest investors in the business. Li Lu, a Chinese former dissident who subsequently became a protege of Charlie Munger, had invested heavily in BYD, brought it to the attention of Charlie Warren. In 2008, Berkshire bought 10% of the company for $232 million, a stake that's now worth billions. And then he said Munger described BYD's founder Wang Chenfu as a combination of Thomas Edison and Jack Welch. Founded in 1995, BYD has started out as a rechargeable battery maker. It then entered the automobile business and later diversified into cell phone assembly and solar cell manufacturing. Leveraging its strength as a battery maker, the company transformed itself into a leading developer and manufacturer of electric and plug-in hybrid cars. So BYD's outstanding results may have originated with Wang's remarkable abilities, but the firm now has the advantage of being able to deploy more than 10,000 engineers at a fraction of the cost that an American or Western European competitor would have to pay. At the time that I made the investment, BYD is not at the center of my circle of competence, certainly not based on my technical knowledge of batteries or electric cars. I might never truly understand those businesses with the granular detail I would want, but the price had dipped and I knew that I needed to pay attention to this opportunity. I had met many of the key players, starting with Li Lu, Charlie Munger, and Warren Buffett, and I had studied them all closely, but I barely knew Wang, nor did I feel equipped to evaluate him or Stella Li, the president of BYD in the United States. All I had to go on were BYD's annual reports, the views of some people I highly respected, and some personal anecdotes and impressions. For example, I was impressed with Wang's demeanor at the Berkshire annual meeting when he saw him sitting in the middle of the entourage of BYD executives, listening with rapt attention. He was genuinely and deeply curious to learn as much as he could from Warren and Charlie. And the other time I introduced Stella Li to someone in my network, she was extraordinarily responsive. My interactions with both Li and Wang had been fleeting and limited, but they were impressed me in the same way that Jack Byrne, Don Koo, and had impressed me when I met them. In the early years of my career, my disillusioning experience of working at a failed investment bank, D.H. Blair, had dented my confidence and made me wary of human nature. I tended to assume that business people I had met had to be mediocre because the very best people would not be in my circle, and if they behaved well, perhaps it was an aberration. As a result, I was typically willing only to trust the hard numbers in the annual report instead of relying on my assessment of the management. But by the time BYD came along, my attitude had started to change, and I was more willing to venture out of this comfort zone. Wang Chenfu and Stella Li struck me as hugely accomplished executives who were likely to continue delivering the type of performance they had produced in the past. Instead of doing a forensic spreadsheet-style analysis of BYD's current operating performance, I looked at the company as a growing organism. I asked myself whether, based on past results and achievements, it was likely to succeed in entering adjacent markets and continue to deliver a great return on its engineering, research, and developing spending. I was also comforted by 2 more things. The company had a history of being highly profitable and seemed central and strategic to China's future. Unlike a gaming company or Maotai, the Chinese beverage brand we used to own, the fact that Chinese government recognized BYD's strategic importance seemed to reduce the political risk of this investment. Still, I wasn't sure if I ventured too far outside my circle of competence, so I sized this at a 5 position of our capital base at the time. This position was big enough so that it would have a significant impact on the portfolio if it worked out, but it was small enough so that if I didn't have to think about it all the time. I felt comfortable ignoring the stock price and only checking in on operating results from time to time. As I had hoped, BYD continued to deliver operational results, but its stock went nowhere for several years. Nowhere. Absolutely nowhere. Meanwhile, one of its competitors, Tesla, was on a tear. Still, none of this bothered me given my appropriate position sizing, so I just sat there and quietly waited. In time, the market recognized BYD's value and the stock had risen in 963%, growing to be almost 15% of Aquamarine's fund's assets. What's the moral? In part, it's about the benefits of partnering with world-class management, operating in an environment filled with exceptional people like Warren Buffett, Charlie Munger, Li Lu, and Wing Chun Fu. In part, it's about having the patience to remain invested in a superior business that was well-positioned to benefit its entire ecosystem. In part, it's looking beyond the numbers in a company's financial statements and seeing the business instead as an unfolding organism that's delivering value to all of its stakeholders. When you find a great business that's developing like this, it's wonderful to own a piece of it and to hold on to it for dear life. Inspired by Monish Pabrai, I used to think that I shouldn't sell stock within 2 years of buying it. Nowadays, I'd be inclined to extend that to 5 years. Honestly, this is one of those things where I just love seeing that he said, it went nowhere for a few years. Can you imagine you're sitting there, you're questioning yourself the whole entire time. You know you're right, you know you're right, you know you're right. And patience pays off. So this is one of those things where holding a position, even when you are down, or holding a position that you know you're right and you've done the research. I mean, obviously make sure to check the fundamentals again, but know that you've done the research. Your conviction's strong enough, you can be rewarded handsomely. Now, the second company that he wanted to talk on is the IEX, or the Indian Energy Exchange. My interest in IEX was sparked during a trip to India in 2018 when I attended a couple of investment conferences and visited dozens of Indian companies. Amongst all of them, IEX stood out as a company with some very rare characteristics. Like BYD, it's strategically important. IEX is essential to India's development, so it occupies what I regard as an economic high ground. IEX runs an electricity exchange that's not dissimilar to a stock exchange, except that it's more critical and central to a country's infrastructure than a stock exchange. Instead of dealing in stocks, a power exchange deals in power flows, which are traded in time slots. Country's electricity grid has to remain in balance from second to second, minute to minute, hour to hour. Otherwise, the whole system can go down. Now, he goes on to talk about the difference between India's exchange and Europe's exchange, and he says, electric power is absolutely central to India's economic development. A key element of this development is the participants in the energy market, from power producers to consumers, must be able to trust the market clearing price for power. IEX plays a crucial role. It provides an exchange on which excess of energy can be offloaded to other market participants. This liquid market provides a reliable price discovery mechanism so that participants in India's energy market have the confidence required to make huge investments into the power infrastructure which India needs in order to grow efficiently. IEX delivers immeasurable value for India by providing this rational pricing. This also happens to be an excellent business in which an established dominant player like IEX continues to win because it's trusted to provide reliable liquidity and execution. I also like the fact that the company is highly regulated and the vast majority of its counterparties are state-regulated organizations. And he goes on to talk about how important that is. And so he said, what also attracted me to IEX was that it has an extremely long runway. There is an immense amount of work that needs to be done in the Indian power industry over the coming decades. Electricity production per capita will need to more than triple for India to reach levels of developed countries. We can also expect a much higher proportion of India's electricity to be traded in the future than it is today. Now, one concern that IEX wasn't cheap, but my thinking has gradually evolved on this front. If I want to buy the best businesses, it's often necessary within reason to pay up. I believe that IEX was worth a premium price given all the forces working in its favor. As with BYD, I initially invested about 5% of our assets in IEX, enough so that it would have a significant impact if it worked out, but not so much that I needed to worry unduly about risk or in particular hurry for the investment to pay off. After I bought IEX in March 2019, the stock did little for a couple years, but the business continued to advance. Then in 2021, the stock quadrupled. As with BYD, I expect that there is still a long way to go, and I intend to hold on to both stocks for years to come. In February 2022, I returned to India with Monish and to meet with Goel, the chairman, managing director of IEX. This visit reaffirmed my sense that IEX stands at the very center of India's developing power infrastructure, position of prime economic importance. The value it can bring the country is immense, and I'm excited to partner in its growth. So again, he found a really good opportunity in IEX, and even though he paid slight premium, I think it's one of those things where if it comes down to it, and you've done everything, you've run the cash flows, you've looked at the statements, you understand the business positioning, if you're playing with a company that's like pretty much the market dominant person, or it's a couple different companies in that space, you should really go ahead and look at what a premium would truly be worth. So maybe instead of 15 PE, you get a 20 PE or 25 PE, but because it's one of the only companies participating in that space, it's probably worth a premium if you can justify it. So make sure to look at these statements, try to figure out where it fits sort of in the mix, and make sure you understand like the position sizing and all that if you're wrong. Then he goes on to explain sort of the market debt, or really the debt that the U.S. has to deal with, and the government as a whole, as far as they have to deal with. He talks about the ways to get rid of it. So he's talked about growth. If you outgrow inflation, or if you just outgrow the interest rate on the debt, it's really not inflation. But if you outgrow it, you could privatize some things, so maybe sell off some assets, or maybe you can get rid of some expenditures that are considered non-essential. He did mention financial repression, so negative interest rates could be one thing. Default, I don't think that'll happen. And then the last thing that he really wants to touch on, and he kind of writes about, is inflation and how inflation works against, there's two classes. So you have the savers and you have the borrowers. And really the savers are people who are, sort of later in life, or at least they're people considered like investors or things like that, versus borrowers like me or someone else in like the millennial generation might be buying a house or buying something on a loan. Because you're getting an interest rate, the inflation eats at that interest rate. So say if you get like a, recently it was 2 or 3% towards the beginning of the year, you get 2 or 3% mortgage, all of a sudden inflation's 9% on the year. You're in the green basically because your interest rate is so low. So one thing he did mention though is just, how do you invest into this inflationary environment? And so I just wanted to highlight it here too. So one popular view holds that staying in equities is too dangerous in this type of environment. In a world of rising interest rates, multiples can only contract, prices must come tumbling down. This conclusion would suggest that you should redeem from the fund with alacrity, and that similarly, I should sell our investments and raise our cash flows. But if we dig deeper, it becomes clear that these are not the best options. Indeed, they are quite probably the worst by a wide margin. And here's why. When it comes to inflation and higher interest rates, the two forces work against each other in the stock market. While interest rates do indeed tend to drive asset prices down, inflation will have the opposite effect and drive asset prices up. That's why stock markets around the world typically do so well in inflationary economies, at least nominally. Under inflation, asset prices tend to rise at a high nominal rate, even if, because of inflation, purchasing power is not improving by much. So the stock market is actually not a bad place to park money during an inflationary period. Indeed, I believe that its well-selected portfolio of equities is by far the safest and best place to protect our savings in an inflationary environment, with the possible exception of high-quality real estate. He goes through some of the alternatives and things like that and why it's important. And he says, thus, in my view, the wisest and safest place to hide from inflation over the long run are real estate and equities. All other assets seem likely to underperform, but which equities under inflation, not all companies will perform equally well. To understand how different businesses will perform amid inflation requires a careful examination of their economic characteristics. I won't bore you here with all the reasoning, but what we're looking for is companies with pricing power that are capital efficient, that have a high return on their invested capital. Ideally, they should have made much of their investment into the business in the past and require limited investment going forward. Which businesses meet those criteria? Certainly not those vaunted tech and new economy firms that are spending vast and increasing amounts of money in the hopes of eventually capturing a profitable share of their total addressable market. By contrast, businesses that will do better than most include banks, financial service firms, and all the companies that are able to price as a percentage of nominal prices. That includes credit card networks, stock exchanges, and the credit rating agencies. Branded and luxury good companies should also do pretty well. So it is interesting to see how convinced and how steadfast he is in holding companies and holding stock and making sure that we're holding good equities. And it's interesting to me that he said here that what we're looking for is businesses that have pricing power, capital efficiency, and high returns on invested capital. It's funny because it sounds a lot like Bill Ackman's way of thinking too. It's interesting to see like how interlocked their thoughts are, and they actually were in part of the same sort of like investors mind group that he had back when he was in New York. So it's not unsurprising, but it's interesting to see like how much of that really aligns. So he goes on to talk about inflation and just the different things, and how the different impacts were, and also he goes through, he was looking at a company in Ukraine, and he's really glad he didn't take that because it's really hard to invest in a geopolitical sphere when countries are really uncertain, like Ukraine, where you don't know, what's gonna happen. So beyond that, he says, over and above these geopolitical considerations, the best way to protect ourselves from economic and geopolitical turmoil is to invest for the long term in good and cash generative businesses that deliver real value to societies where they operate. Companies like Berkshire, Moody's, Bank of America, BYD, and IEX. In my experience, there's no benefit to trading in and out of long-term holdings like these in the vain and hope that you can time the market. It's simply better to stay put and ride it out. In times of turmoil, fearful or irrational investors often decide to cash out of the stock market until the dust settles, or they sell individual stocks that they hope to buy one day at a lower price. This may seem like a smart precaution, but it tends to be a fantastically reliable way to destroy your investment returns. One reason is that it's all but impossible to time your exit from the market and your return to the market. If you get lucky, make a well-timed choice on the way out, chances are that you'll fail to get back in at the right time. Why does this matter? One reason is that the worst day in the stock markets are often followed quickly by the best days. You don't want to miss out on those sharp upward rebounds, which can account for a lot of the market's overall return. Please look at the chart on page 22, and I'll show you that at the end, which shows that you would have earned 9.4% a year by investing in the S&P 500 for the last 20 years if you simply staying put. If you had missed just the 10 of best single days in the market over those 20 years, your annual return would have fallen to 5.09%. What if you missed the 30 best days of those 20 years? Your annual return sank to 0.21%. The moral of the story is simple and really important. Do not try to time the market. Do not sell. Do not trade. Do not delude yourself into thinking that you'll know when it's time to get back in. Simply ride out the stressful times, endure the volatility, benefit from the long-term upward trajectory of high-quality businesses that compound over time. I hope this is clear. The reason I feel so strongly about this is that I've seen this movie before during the global financial crisis 2008-2009. Several investors in the fund got rattled and cashed out, locking in significant losses during that period of extreme volatility and then failing to benefit from the immensely profitable rebound that followed over the next decade. Let that person not be you. So it's really interesting. He goes on to talk about a couple other things, but here you can see the numbers he's talking about and the performance. It's really interesting to see what the impact is of just not being invested and staying invested. And then the last kind of thing he had mentioned was, to emphasize this once more, let me quote Bill Miller, who recently explained why he shares this belief. In the post-war period, the U.S. stock market has gone up in around 70% of the years, odds much less favorable than they have made casino owners very rich, yet most investors try to guess that 30% of the time stocks decline, or even worse, spend time trying to surf to no avail. The quarterly up and down waves in the market, most of the returns in the stocks are concentrated in sharp bursts, beginning the periods of great pessimism or fear, as we saw most recently in the 2020 pandemic decline. We believe in time, not timing the market, is key to building wealth in the stock market. I couldn't agree more. Timing the market, not timing the market, is a key to long-term investment success. So that's really all I wanted to bring to you today. I think it's really interesting. I've been listening to a lot of Guy Spier's speeches and talks and things and conversations, and really I'm gathering, and I'm trying to, mold my way and figure out my best way of investing for myself in my own portfolio. And it's really been insightful to see something like this, where, it's better to be fully invested than to miss out on certain days. So with that being said, in these volatile times, I'm going to keep trying to bring you all that best education and the best, information and things that I find, and try to explain things like this, because I think the investment letters are really, really helpful, but a lot of times they only come out once a year. So I might do like another investment letter if I can find like a memo or something. We'll try to do that. But with that being said, thank you all so much for joining. Let me know if you found this interesting. Let me know if you want to look at anything else, give you any thoughts on anything else, or if you have any stocks you want me to look into, let me know down below in the comments. With that being said, have a great day and happy investing. Thanks.